everyone. This is Abhijit Chatterjee recording our Chartsarefun weekly session. This is for the week of February 17th, recording this on the Sunday, the February 23rd. Today's agenda is simple. We're going to talk about NVIDIA's earnings. NVIDIA is going to come up with earnings. It'll last for the Magnificent Seven to announce earnings on Wednesday, February 26th. We look at what the chart is telling us. There's been a lot of anticipation of mixed feelings. There are folks who are bearish on NVIDIA, feeling that the hardware cycle of AI spending is going to kind of start decelerating, and as a result, NVIDIA could tank. We know that there was the DeepSeek scare that brought NVIDIA down significantly, and then it did recover back, close the gap out. So there are folks who are being very bearish on NVIDIA. We'll see what the chart is telling us. And then we want to really talk about the market. At this point, February tends to be a seasonally weak month. We know that we got a very sharp pullback on Friday. This was with options expiration, and Michigan consumer sentiment came out reflecting a lot of anxiety from the American consumers worried about inflation. Inflation concern seems to be the biggest concern, realizing that President Trump's tariffs would be inflationary, the overall concerns of deficit spending, and just the concerns of how the economy is going to perform in the next several months. So we did talk about something very interesting last week. We talked about anticipating a VIX kind of a volatility increase, and that was based on a market breadth indicator called the New York Stock Exchange Summation Index. We're going to go over that, and we'll share with you what we think the market could be doing in the next few weeks. With that, this is our Chartsarefun blog site. It's in Substack. We appreciate you subscribing to it. Just share your email, and we'll send you an email as soon as the blog gets published, usually in the mornings. And then so that's chartsarefun.substack.com. The weekly videos come out in our YouTube channel at Chartsarefun. We appreciate you subscribing to this channel and also liking the videos if you like the content. Our goal really is to not provide investment advice, but to share interesting chart patterns that you can guide in your investment decisions. We do believe charts are fun. We believe there's very interesting patterns, how they kind of help read the tea leaves of the market. And that's what we try to share with you and hopefully educate you in seeing these patterns. So we said we're going to start with NVIDIA. So this is the daily chart of NVIDIA. Every candle, or you could call it the red or the white bar, is a candle for a days of trading. What NVIDIA had done in the early part of the chart here, which is the summer into October, this was a beautiful ascending triangle. The resistance level at 131, that's the horizontal line, and then the climbing higher lows was the ascending part of the ascending triangle. This pattern from a 90 to 131 is $41. At 41 to 131, that measured to a target of 172. NVIDIA didn't quite get to 172. It went to 152, almost 153. From there, pull back to a level near 126, went up to 153 again. And then from there, it was kind of hovering in that range between 126 to 153 till the point when this gap down happened on very heavy volume. This is the gap down that happened late January from the DeepSeek scare. Market got nervous that, you know what, DeepSeek is going to be threatening the AI models at a much cheaper cost of adoption. As a result, they felt that NVIDIA's growth scares wouldn't really pan out, and NVIDIA may not grow as much as the market was thinking. So that bears started calling it a double top. So when you see a double top, it's almost like an M shape. So you start off from like maybe from the 90 level, climb up to 152. That's the M, the left part of the M. Then you pull back from the valley of the M towards 126, back to 153. If you measure target on that, that's closer towards the 100 level, which we've tested in early September. That's what the M shape double top breakdown comes from, 126 to 153. That's roughly, you're talking about, 27 points. So 27 to, it's not exactly 126, 126.7 or so. It kind of measures closer towards the 100 level. So that's a possibility if the bears are correct. However, if you're looking at the ascending triangle measuring to 172 and the very recent strength in NVIDIA's recovery from that gap down, it recovered, it touched 113 and has been strongly climbing. 113 to 143, this is kind of a cup that it has formed. Pull back the last 3 trading days to form a handle. If earnings is strong on Wednesday and this cup and handle breakout happens, 113 to 143 is a $30 difference. At the $30, that's how you measure a target on a cup and handle. At the 30 to the 143, you get to 173, which measures to a similar target as from this ascending triangle towards 172. So bulls would point to a potential upside in NVDA after earnings. We can see that the red moving average, which is the short-term 20-day moving average, is about to cross above the 50-day moving average, which is called the silver cross. So the 20 potentially aligned to go bullish above the 50. So that's a silver cross, which is bullish. The cup and handle breakout, and look at the accumulation distribution. Since that deep sea scare, which heavy volume sell-off, no question, there's been accumulation, not that AD was declining while this was climbing. That would have been a bearish sign. AD has been climbing higher highs, much higher than what we saw the most of second half of last year. That higher high in AD indicates smart money accumulating on NVIDIA. So if as much as Wall Street wants to scare you about NVIDIA, there are many in CNBC who've been talking about, oh, their hardware cycle spending is going to start decelerating. Dan Niles, for example, has been warning about this, and others. Charts saying something else. Charts saying it looks bullish. The accumulation shows strength in the NVIDIA stock in terms of smart money buying the stock. We potentially could have this silver cross and this cup and handle breakout. So we could watch and see what NVIDIA does on Wednesday. We know that their biggest spenders, which is the hyperscalers, have all upped their CapEx spending. We know from the Microsoft, one of the largest, second largest company out there, they upped their spending to $80 billion of CapEx spending for this financial year. We know that Amazon was huge, from less than 60 billion of CapEx spending for 2024. They've increased it over 100 billion for 2025. And then, so that's one of the largest CapEx spending on AI and hardware in general. So Amazon over 100 billion, Microsoft at 80 billion. We know that Google has promised 75 billion of CapEx spending in 2025, and Meta has also talked about 65 billion of CapEx spending. All this is a good omen for NVIDIA, because where do you think a lot of this CapEx spending goes? It goes into GPU buying. There is significant shortage of compute capacity. All these hyperscalers, Microsoft, Google, and Amazon have talked about. They feel that by investing into this CapEx spending, into the infrastructure, into GPUs, they will be seeing more cloud growth. So they are expecting acceleration of cloud growth into second half once they get this CapEx spending invested and their data centers kind of more compute capacity added in the data center. So this means NVIDIA would potentially have not just a blowout quarter, also a blowout guidance for the next quarter is what the market will be looking at. It's going to be, of course, a very high bar for them to climb, because we know that market just keeps expecting double digits and astronomical growth ever since the 2023 massive upside in NVIDIA. Market only expects higher and higher limits, but the sky's the limit in terms of the way these AI spending keeps going on. And let's not forget that we're still in the part of where AGI, the artificial general intelligence, is not here yet. Some say that with ChatGPT's next model that comes out will hopefully, GPT-5, will show some signs of AGI. That will kind of almost get to human kind of intelligence. So that's why it's called artificial general intelligence, will be human-like intelligence. We're still few months to years away from it, so which means you need all the AI to train. It's not just come to an inferencing part of AI that many feel that, you know what, the hard part of training is done. We've hit a plateau. We can't train any further. So now inferencing is not as compute intensive as training. So you know what, the compute cost would come down. I think the chart's telling us, if you look at the tea leaves of the chart, potentially a bullish resolution to NVIDIA, which could really help the market climb higher highs. That's the way we're looking at it. The Magnificent Seven for the entire year in 2025 so far has been flattish. Most of the earnings were poorly received, except Meta. Meta kept shot up 20 successive days. It kept climbing, crossed the 700, recently dipped below 700, but hovering around 700. Other than Meta, every other stock got hit in the Magnificent Seven group after earnings. So let's see if NVIDIA kind of takes Meta's path, blows out earnings, grows from this bullish cross, and heads towards the 170. That's what we are thinking NVIDIA potentially could do next week. Now, after the big scary sell-off that happened on Friday, this was options expiration, monthly options expiration happened yesterday on Friday, and there was Michigan consumer sentiment that showed back to November 2023 kind of low sentiment out from the those that were polled. Tom Lee was out in CNBC, and he still seems extremely bullish on the market. He considers this as a buying opportunity for the market. He thinks that this was a classic, buying opportunity. Why? Because in 2025 so far, the pattern has been that we've had a few pullbacks, starting with DeepSeek. Then we had the Canada and Mexico tariff scare where Monday market tanked. So 2 consecutive Mondays market tanked, first DeepSeek and then the tariffs. And then we had this big sell-off on Friday this week. According to Tom Lee, this has been a buying opportunity every moment. Investors have been snapping up the stocks, the beaten down stocks, and have been a lot of sideline cash out there. And he believes that so far the market has acted bullish. And the other part that he's stating is you've rarely seen tops with this much of pessimism. There seems to be a lot of pessimism in the market. Market somehow is very concerned every time the market hits a top that, perhaps, hey, we are topping out here and so on. So he feels that there is pent-up demand to keep the market coasting higher, and hence he's bullish, and he felt that this was a buying opportunity. I'm going to share a very interesting pattern we talked about last week, but I want to reiterate because that's where our prediction was that when we recorded last week's session, we talked about a potential market pullback and a potential volatility climb. And that's exactly what happened in the red region, as we see where VIX did climb from the 14, 15 levels to the 18, closed above 18.2. And the pattern that we said would repeat is every time this New York Stock Exchange Summation Index, which is the advancers minus decliners, it's a cumulative index. So whenever you have rising patterns, market overall climbs. When you have declining pattern, market overall breadth gets worsened. And not the largest index S&P, but small cap, you can see has basically come down since its November peak. But there's been strength in summation index, then decline, and now we've just started climbing for about a month now. In the daily chart, which is a short-term chart, every time in these blue elliptical regions, we've had the MACD histogram. This is the moving average of the 12 and the 26 period moving average of this summation index. Every time that MACD from the 12 to the 26, and then you're having the 9 number is the smoothing average of the period. Take the difference and take a 9-day or a 9-period smoothing line with the red line. Every time the black line, which is the difference between the 12 and the 26, crosses below the red line, that black below the red indicates the histogram. This is the histogram drawn in blue, crossing below the 0 line. Every time that crossover happens, VIX spikes. So that was early August. Early September, the crossover happened, VIX spiked. Back again in early October, the crossover happened of the black line below the red line. VIX doesn't always have to be as aggressive spike as we saw in August. This was, of course, the Japanese stock market crash. That was quite an outrageous big movement, but then it went from the teens to 38 on 36, 37. Doesn't have to be always that much, but VIX does climb every time the MACD histogram goes below the 0 line, and we are just about getting ready for that. We can see that the MACD histogram has narrowed down. We can see that the black curve has narrowed and about to cross below the red. So we could see a few days. Each histogram here, each blue is for single day of the summation index. So we could see a few days, which is early part of next week, Monday, Tuesday, Wednesday this week, we could potentially see some downside continue in the market from what started at Friday. And this could mean that VIX could perhaps climb a little more. But that said, if you look at the longer term chart of the summation index, we are just about begun to climb, where the MACD histogram on the weekly chart is only gone positive for 2 weeks. Here from daily, we've come to weekly. Every bar here that you see is a week of the summation index. So we've now climbed for the last 6 weeks, 1, 2, 3, 4, 5, 6. But typically look at the climbs when they come for 10 to 12 weeks. So 6 weeks is only midpoint. We could see another 6 to 8 weeks of upside climb on the summation index. We can see that the MACD barely touched above zero. We can see that the black line has crossed above the red, and now these could be climbing to go to the positive part of the region. We can see that it spends time in the positive, then it comes back to the negative, then it crosses, spends time again in the positive, comes back towards the negative, goes back up again. We are just about, from the histogram, gone above the zero line, but the black and the red line are yet to climb. They just about begun to climb. So we could see on the intermediate term further upside in the market. That's what the summation index is telling us. Market breadth, by the way, moves from anywhere from the 1100 to the minus 1100. That's typically the range of the summation. It's a cycle indicator. We've hit 1100 last around late September, early October. From there, pulled back to minus 435. We could make another climb towards 1100. Now, what tells us that that's a possibility? Let's look at the S&P 500 daily chart. Here we see a beautiful ascending channel. In the tops that you joined from the August level, that's a beautiful line on the top. Parallel to that is the line joining the bottoms. We see that from 51.19, which was the August 5th bottom, it has been climbing successively higher highs, till the point where recently we've been testing 61.28, 61.47 twice. This was a very bearish kind of a pullback. We can see that we've almost pulled back 1.7% and started off from near 6,100, closed near 6,013. Tested the 50-day moving average, which is drawn here in blue, which is right around 6,009 and closing above it. We did dip below it at 6,008 intraday, but closed above it at 6,013. So this, if it breaks down, bears would point that, you know what, it's going to go all the way down towards the 200-day moving average, which is near 5,700. However, if it holds this ascending channel, which is right now the low part of the ascending channel is climbed now close to the 59.50, 59.30, 59.50. So if it holds that, which would be yet another higher low, right? From 51.19, been climbing 57.73. If it holds at 59.30 to 59.50, a higher low and then climbs. Possibility of the summation index on the intermediate term climbing further with the black and the red line climbing up above the zero level, and with this turning back and testing the upper end of the channel, which is climbing and could head towards 6,500 by the time it gets to the summation index getting to the positive level for the next several weeks of climb. So measure target on this could be a cup and handle of 6,100 as the left rim of the cup, 57.73 back to 61.28, then a bit of a handle move and then a breakout higher. 57.73 to 61.28, you're talking about 355 points. Add 355 points to 61.28, you're talking about 64.83, close to 6,500. So potentially that's the possibility. That's what the bulls would look at. This would test it, keep climbing, and potentially go to the top end of the rising trend line, the ascending channel towards the 6,500. Let's look at the longer term monthly chart and look at what the bears would be pointing. Bears would be pointing to, in this particular case, a repeat of what happened in 2022. We can see that the market has climbed a lot from what we saw in 2020 COVID bottom at 2191 to 4818, to the point where you can see how much the price had diverged from the rising 50-month moving average. You can see the gap between the top end of the price at 4818 to where the 50-month moving average was. Look at that gap now. similar dimensions, right? Similar dimension of the gap right here from where it is to where the 50-day moving average is. 50, not the 50 month. The 50 month is at 4,600, and right now we are at 6,000, talking about 1,400 point difference. Here it was somewhere around 3,500 towards the 4818, about 1,300, 1,400 difference right there. So that's the magnitude of how far it has diverged from the rising 50-month moving average, and bears would point to a potential correction setting up in 2025. They would point to uncertainty in the tariffs in terms of the as much as President Trump is going to be market growth and going to be driving market growth, but there are risks with his policies that could effectively bring down the market, is what the bears would point at. Now, a key part of technical indicator where bears could have on their side is we can see that the MACD on the S&P 500 histogram has begun to form a beautiful histogram, kind of a bell-shaped curve, to now begin to decline. You can see the last three, since that peak around, say, July, August of 2024, we can see that successive histograms are coming at lower highs, to the point where this actually beautifully curves up and then plateaus and starts curving down, just like we saw here in 2021 to 2022. So folks would point this to be late 21 kind of a situation, with the MACD histogram finally curving down below the zero center line and then going negative. That's what the bears would look at and can't be ruled out. If looking at how much the market has moved relative to the 50-month moving average, there's a possibility that the bears could turn out to be right. But in my opinion, that could come after we see this 6,500 move. It's just because of the summation index on the intermediate term telling us that we've just crossed. It's been 2 weeks of upside. There's more weeks of upside. Typically, you see the durations of these ups and downs. They go on for several weeks, and once they cross, they go on for several weeks before they turn down again. So if you look at that, this was a very long duration MACD histogram below the center line, below the zero line. Then it went up, spent like 5-6 months, then it went down, and now we've just crossed it. We can expect another few weeks, at least 4 to 6 to 8 weeks of continued upside before it starts dipping below the zero line again. So potential move for the market is good chance that, yes, we may kind of move up another month, or each histogram here is for 2 months. So look at what happened in 2021, late 21. Just when we thought that the MACD was dipping down, that last month of 21, December, had a nice up. So you thought that this was a bearish kind of reversal, gravestone doji kind of a candle. So market had topped out. Well, the bears were wrong. The bulls fought back, and they had a beautiful upside in that last month of December. And then from January is when we started coming down. I believe March is going to have a similar kind of a pattern. We're setting up for a very similar candle here, like in November 2021, a bearish looking reversal candle, but I expect a strong month of March, similar kind of a month like we saw in December of 2021. A strong month of March that takes us to a higher high of S&P towards the 6,500. Many are calling it a melt up kind of a situation possible. And that effectively could come with either the taxes that President Trump had put in his first term to be extended. That could be market friendly to have the taxes extended, and maybe some form of deal making on the tariff front that could be positive for the market. So with that, we think that potentially there is that upside. And also, if you look at the channel drawn on the S&P chart, just like we drew a channel on the S&P's daily chart, this is a much longer term monthly chart going back all the way to 2005. It's talking about 20-year S&P chart. Every candle here is a month. In that monthly chart, if you look at the channel joining the tops and the bottoms, this is joining from the 2009 low at 666 to 2191. We can see that we are not yet at the top of the trend line. Still some more upside closer towards that 6,500 level. So there is the possibility that in the next month, in March through April, we go and touch that. And then that could be a potential sign for the market to pull back like we got in 2022, right? And that pullback, I don't expect to be back to the bottom end of the trend line. The AI trend continues to be bullish. President Trump is market friendly. I believe that if that pullback does come, the maximum we pull back is closer towards maybe a 15, 20%. If we do get a pullback like we got in 22, that would be the rising 50-month moving average, which is right now 4,600. But by the time we get there, by the time the pullback comes, we could effectively, this has been climbing, we could effectively climb to 4,800 to 5,000. But I doubt if you're hitting 6,500, potentially a 20% correction would from 6,500 bring us to 130 points, 1,300 points lower. From 6,500, 1,300 points lower is 5,200. So if any, 5,200 is a possibility, but a retest of that 4,818, which is a 2022 January peak, is a possibility. That would be likely where the 50-month moving average would climb to by that time. So 4,800 pullback can be ruled out if we get a similar kind of cyclical bear market like we got back in 2022, and could be for a few months, and we could get that pullback here, but that's to be seen. But right now, we remain bullish. We think that, to sum it up, NVIDIA potentially results on the bullish side. The bears are looking for the double top breakdown, which measures towards the 100. The bulls are looking for this cup and handle breakout and this ascending triangle target near 170 to 173 to be met. And on the S&P chart, we believe that the ascending channel that we see here could potentially be tested at the top end of the channel, primarily because of the summation index having more upside from its weekly chart and getting us towards that 6,500 level. Good luck investing. We'll talk to you next week.